Hi, and welcome to Business Advisory and Tax Tips. This is Michelle Burke coming to you live from Annapolis. Many of you know that after 30 years in the corporate tax world, in January, I created health and taxes. There are only two things that are certain in this world, death and taxes. I'm here to help you do a health check on your business and on you. Most of you know that each Wednesday I come to you live to give a little update on the second stimulus, which I'll be doing. But also I have a special guest that I'll be introducing shortly, and we're going to be talking about investments and how to account for them. So stay tuned. First, let's talk a little bit about the second stimulus. Many of you know from last week that we talked about how the House came up with a draft. They collaborated with 50 members and came up with a $1.5 million draft bill, 5 trillion, let's be clear on that T, draft bill. And we were hopeful then that that draft bill would go through the House and then possibly onto the Senate. However, there's been a couple things that have put that bill into a back seat. The first of which is the Supreme Court nomination. The second of which is the federal fiscal budget. The good news is that the House passed a government funding bill last night. This is a continuing resolution that'll go through December 11th. And it is expected for this to go to the Senate tomorrow or Thursday or Friday, and is expected to pass. So that's really good news in the sense that it went through the House. It's expected to go quickly through the Senate. So at least through December 11th, we won't be held up, the Congress and Senate won't be held up from doing the all-important stimulus work and other important things. So if there's any good news, that's the good news. The unfortunate news is there's still no stimulus. I do wanted to mention that Jerome Powell, the chairman of the Federal Reserve, did testify before Congress. He was a strong supporter for a second stimulus and really saying that the economy needs a second stimulus. Steve Mnuchin was also testifying before Congress, also backing a second stimulus. So again, there's lots and lots of support for the second stimulus. Unfortunately, we're just not seeing a final bill. So stay tuned and we'll continue with that. So given kind of this year with the stock market going up and down and many people having to pull money out of investments, I thought it'd be a good time to revisit the rules behind long-term and short-term capital gains and talk a little bit about investment strategies and options that are available. So with that, Jeff and I have teamed up to educate you on investments and how to account for them. So first, I want to welcome Jeffrey McMahon from LPL Financial. Welcome, Jeff.
Thank you, Michelle. It's a pleasure for me to be with you today.
It's great to have you. So let me give you a little background on who Jeff is. Jeff is in his 37th year in the financial service industry, and he's beginning his 23rd year as a licensed financial advisor. He has worked for Merrill Lynch, Morgan Stanley, and Wells Fargo. He won the National Sales Director and Rising Star Awards while at Morgan Stanley. He also graduated from Carnegie Mellon University with a BS in Managerial Economics with honors. He's also a lover of cats, and we all know that I am also a lover of cats, but that's not for debate today. We will get on with investments for now. So let me tee it up a little bit here first, and let me just talk, let me set the stage a little. I want to remind people what are the current prevailing tax rates and what's the difference kind of between the short-term and long-term investments or gains. So let's just be clear that we're talking about financial investments. And what I want to also say is nothing that what Jeff and I are saying today is supposed to be tax advice, nor is it financial advice. It is simply educating you as our listeners. So I just wanted to be clear on that. So many of you know that short-term capital gains or investments that you've held for less than a year, and long-term capital gains are investments that you've held greater than a year. And when I say gains, that assumes that your selling price is higher than the price that you acquired it at. There's also short-term capital losses and long-term capital losses. There's rules on how much capital loss you can utilize. Capital losses are first netted against capital gains, and then you're only allowed as an individual to take $3,000 per year of capital loss capital loss in excess of gains on your tax return. Now you can carry those forward, but a lot of times people are looking to maximize if they're realizing either short-term losses or capital long-term losses. They're looking to maximize those or offset those with their gains. So let's talk about tax rates and current prevailing tax rates. Short-term capital gains, and the reason there's a distinguishment here is they're taxed differently. Short-term capital gains are taxed at the prevailing individual's rates. So we all know that there's 7 different levels of tax rates, and the lowest bracket is 10%. The current highest bracket right now is 37%. That's set to expire in 2025. While long-term capital gains, those have a favorable tax treatment. Long-term capital gains can be taxed at 0%, 10%, or 25%, depending on your income brackets. So it's often in your interest to hold something longer for at least a year to generate capital gains, to get capital gains treatment, but that's not always possible. And that's something that we kind of want to address here today. The other thing I just want to mention is that for taxpayers that earn greater than $200,000 as a single taxpayer or $250,000 as a married taxpayer, there's also a net investment tax, and that's 3.8%. So that's in addition to the short-term ordinary gains or the long-term capital gains rates. So just want to make you aware of that. Since we're coming up on an election, it's also a good time to mention that should President Trump retain his position, we're expecting for the most part for the taxes for capital gains, at least in the individual rates, to stay constant. That said, every once in a while, President Trump discusses maybe lowering capital gains rates even further. Now, Biden has come out. He has a tax proposal out there, kind of his platform for what he is running on. And in there's a couple things I just want to point out. The first is that he would propose to increase the individual tax rates so that that highest level today, that's 37%, would go back up to the 39.6%. And he also has a proposal out there for capital gains. If a taxpayer has revenues greater than $1 million, capital gains would be taxed at ordinary rates, not at capital gains rates as we know them, not at those favorable rates. So I just want to throw that out there just so we all kind of have a framework from which we're talking. So with that, Jeff, let me reach out to you. And first of all, you want to tell us a little bit about what you're seeing in the market. I mean, the market has been kind of crazy this year. It's election year. And talk to us a little bit about interest rates.
Michelle, that's a great question. Interest rates are very low. Historically, probably the lowest they've been in our lifetimes and our generation. So a lot of my clients are reporting that they do have cash and assets sitting in a bank account, earning somewhere between 0 and 25 basis points, which is unsatisfactory to them. So for my conservative investors, the first option we choose is looking at the bond market. You can get a corporate bond, which carries an interest rate, but they've been coming down. And this is probably going to be in your bailiwick again, or up your alley. It's going to be taxable. And the second option they have is, depending on what state they live in, a tax-free municipal bond. So our clients that live in Maryland would like to be choosing from the Maryland inventory. Our clients that live in Virginia would be choosing from the Virginia inventory. Our clients in DC that are DC residents are able to pick any of the 50 states, so they have a little bit more flexibility there. You may want to talk to our viewers about the benefits of the munis versus the corporates, but that's the first leg of the stool that I use to gain customers and clients a little more interest than they may be seeing at the banks.
Yeah, thanks, Jeff. So first, you're right. These historically low rates, how long will they last? A lot of people I've heard report last week about how much cash, because a lot of people are, struggling to pay their bills, but there is a lot of cash being set on right now. I also heard that they're predicting a lot of M&A activity, mergers and activity in the fall, simply because there are some businesses that still are generating cash, and there's just pinup cash that that needs somewhere to go. So yes, absolutely, there are benefits, double dipping of tax-free municipal funds that we want our listeners to take advantage of. Reach out to me if you have questions on what types of benefits you can get from those tax-free investments. So Jeff, talk to us a little bit, like what should people be doing or thinking about? What kind of strategy should our investors out there be thinking about?
Well, the next leg from cash to bonds is stocks, and that involves a little bit more risk. Most stocks pay a dividend. Some stocks do not. Many of the technology stocks do not pay a dividend. And they're selling off because of some of the uncertainty in the market. Some of that is the political uncertainty that you talked about earlier in this call. One of the strategies that I'm fairly proficient at and have been doing for many years is the strategy of taking a stock that you may own and selling a call against it. It is known as a covered call strategy. It is considered conservative in the marketplace in terms of strategies that an investor can employ. And it is very lucrative if you own a stock and it has some volatility to it, which means it moves a little bit. You can sell an option against your position, and either the option will expire valueless, or your equity, your stock, will be sold away from you at the strike price that you set for it. So either way, you're probably making money. And interestingly, this will go right back to Michelle Burke, because Michelle will have to determine whether the sale of the stock was a long or a short-term capital gain. The act of selling the call is a short-term capital gain. And again, this strategy can be lucrative for your clients that either own equities or have the cash that you were talking about reserved in a bank, and they're getting a bank statement saying that they're earning 0.3%, and that may not be acceptable to meet their needs. So they may want to invest that money in a stock and have it produce the income that they need through the conservative covered call strategy. Again, the bad news, if there is any bad news, the good news is the covered call strategy is quite lucrative. It's actually very lucrative. It is a very good way to earn immediate high levels of income. And I do this for many of my clients, and they're very happy with the strategy. If there's any bad news, it's the actual selling of the call premium becomes a short-term capital gain. So I've recommended to all of my customers that not only do they have an experienced financial advisor to execute this strategy, but it must involve an experienced tax advisor as well, because their 1099 is going to be measured in many sets of pages, not just one or two that they had getting from a bank saying that they earned $30 in interest. So your update on the short-term capital gain environment is very timely, because the selling of the calls right now is probably the most lucrative strategy I'm using for my clients that own equities, but it will involve an experienced CPA. I think I can think of one.
Thanks, Jeff. So that's good to know that there's a strategy out there that's quite lucrative, and it's related to doing these covered call strategies. And we know somebody to reach out to get that advice from and to help with. But definitely one thing to be keeping in mind is that if you're doing this inside of a Roth IRA or inside an IRA account, there isn't a immediate tax consequence on that, right? So that's one thing to really be keeping in mind, versus if you were just holding it in that bank account that you suggested. One of the things that we definitely should talk about are different types of accounts that you might be holding your cash in, whether it's that bank account, whether it's that SEP, whether it's a Roth IRA, whether it's a 401k, whether it's a money purchase plan, how you're holding your account, how you're holding your cash today, because that's really going to impact whether you have a taxable event today or whether you have a taxable event in the future, or never at all, whether it's a tax deferral strategy or no tax at all. So back to you, Jeff, on our strategy talk here.
Well, I did want to mention that the act of the writing of the covered call is a little bit complex. The advisor needs to know things like, when does the company come out with earnings, which could affect the price of the stock. You'll need to know the ex-dividend dates, when the dividend goes X and when it's payable. Again, that's going to go on a 1099, and that is going to go right back to Michelle Burke, the CPA. So these are all things that you want your FA and your CPA monitoring for you. Once you've established that, you need to come up with the strike price for your option that you're willing to sell your stock at, as well as how long you'd like to be short that option. It could be a week, it could be several months, and it takes an experienced financial advisor to do that with you. You need to review the chart for support and resistance points. That's probably something that your CPA will not be doing, Michelle. So you're off the hook of analyzing individual stock charts. That'll be my responsibility. But the CPA will see and get notification of the call premium that was realized upon the sale. That's for the investor to keep, come what may, and that's good news. But again, that's going to be a taxable event. And if the stock is sold upon exercise because the stock went up above the strike price that you and your advisor set, it will be liquidated, it will be sold, and your CPA will have to measure the whether there was a gain or a loss, or whether it was short-term or long-term. So that's the issue of going from cash in the bank to a muni bond to investing in stocks. And I do fervently believe it takes a experienced financial advisor and an experienced CPA for clients to really do it properly and have some type of planning associated with it. So I think the two people we have on this call are very appropriate for anyone who would like to explore the strategy and do it correctly.
I wholeheartedly agree with you there, Jeff. And one of the things I'd advise our listeners to do is, we're entering into the fourth quarter. Now is a good time to review where you stand with short-term gains to date, long-term gains to date, losses to date. Take a review of your statements, see where you're at, see what you have room for, look at your different investment instruments, where you have your investments. So it's a really good time right now to review that and see where you are, see where you want to go by the end of the year, and kind of look at if you have room, if you have things that you want to realize, maybe some losses because you still have room, or if you have a lot of room for advantage to take care of these short-term options. So with that, I want to say thank you, Jeff, for joining me tonight or today, And I want our listeners to know how they can reach out to you. So what's the best way for our listeners to reach out to you if they're interested in getting a little more financial advice and getting some expert guidance through these covered call strategies?
My email, Michelle, is jeffrey.mcmahon@lpl.com. So I think you're posting that on the bottom, and it's an easy way to get me. I do check my emails daily, including weekends. My direct line is 302-383-9684, and I'm also available to friends and potential clients and anyone who would like to talk about what we discussed on this call at any time. So I'm always eager to do that.
Great. Thank you, Jeff. So to all of our listeners out there, thanks for joining us today. Please feel free to comment. We'll follow up with any comments that we receive. Feel free to reach out to Jeff or myself directly. We'll come back to you next week on, I will start again with an update on the stimulus, and then we will go on to talk about what types of accounts that you should look at, which types of accounts are best for these covered call strategies, and we'll walk through some of the tax benefits of using these different accounts. So Jeff, anything you would like to say in wrapping up here?
No, I think we covered a very complex topic very well, and I like the way that you're setting up a second video for our viewers, because there are ways around having to incur some of the high short-term capital gains costs and liabilities that you so well talked about today. And so if we can do this in a retirement environment, pardon my rhyme there, there are accounts that our friends that we know in the industries that we see around Annapolis, such as real estate or realtor or individual business company owner, sole proprietor, that can reduce their taxes for their income and also greatly reduce their liabilities for the taxes that their investments generate. So I think that'll be a very exciting call.
Great. Yeah. Looking forward to continuing this series. For all of our listeners out there, please let us know that you found value in this. Please let us know if you have questions, and we will follow up on that. Otherwise, we will see everyone next week at 5 p.m. Eastern Time for a continuation on the series and talk about the different account types to invest in. All right. Thank you so much, Jeff, and thank you, everybody, for joining us.